The impact of economic cycles, and thus timing the real estate market, affects your home's value more than location, renovation, or hesitation. Hi, I'm Creed with Smart Sell AI. This is part one of a multi-part series on timing the real estate market to keep you from receiving an economic enema just because you live in a house. And this video series is not some salesy BS, but an honest, in-depth analysis of your home value risks and what you can do to control them, whether you're an owner, seller, buyer, or investor. In this video, you'll learn 2 points helping you to CYA as you make decisions to sell or buy real estate. In subsequent videos in this series, we'll add to your knowledge and expand our list of smart sell strategies. By the way, in all the charts, the vertical gray bars are recessions. If you've dealt with the real estate market any time in the last few years, the good news is you're not crazy. You're simply not dealing with the same real estate market that your grandparents or even your parents bought and sold in. And if you are the grandparents or parents, today's real estate market is nothing like you've dealt with in prior years. Using home sale prices going back as far as I could find in the Federal Reserve Economic Data, FRED, please note how from the early 1960s to about 1970, home prices had a slight, stable slope and a very smooth trend line suggesting predictable prices and very little volatility. By 1971, home prices were increasing at a greater rate but still had limited volatility. Oh hey, any guesses what happened in 1971?
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
And by the way, mortgage-backed securities, the investment instrument which helped destroy the real estate market and global economy between 2007 and 2013, were introduced 3 years prior to the U.S. leaving the gold standard. Let's call what happens between each series of red lines our home price heart rate. And just like your human heart rate, a rapid increase and uneven pulse suggests stress. With our home price heart rate, narrower distances between the red lines demonstrate lower price volatility, and wider gaps demonstrate greater price volatility. 1970 to 1980 shows an increase in the rate of home values, but still limited volatility. 1982 to 1990 has an increase in the rate of home values and increasing volatility. 1991 to 2001 demonstrates a continuing incline in our home value trend line, but a bit more volatility. 2002 to 2007 has skyrocketing home values and extensive volatility. 2010 to 2020 again has rapidly increasing home values and the greatest volatility in our records. Just after the COVID recession, home values go nearly vertical. Feel it? Let's now look in greater detail at 3 time periods where values increased, but at substantially different rates. If you were fortunate enough to buy your home in 1991, just after a recession, you earned a 46% value increase over 10 years before the next recession hit. If you bought your home in 2002, just after a recession, and held it until 2007, you earned a 44% value increase in just 5 years. That's a value increase at twice the rate of our first example. If you bought your home in the second quarter of 2020, the end of the COVID recession, and held it just 1 year, you earned a 17% value increase. If this value velocity continues for 5 years, you will earn 85% value increase, twice the rate of our second example, a rate never seen before. So the rate of the value increase from example 1 to example 2 was twice as fast. Then example 3 was twice as fast as example 2. Based on our 3 value increases studied, and the blue trend line here, we go from home values with slight increases and almost no volatility from 1962 to 71, then home values with greater increases and almost no volatility from 72 to 82, even during 2 recessions, to home values with continuing value increases and increasing volatility from 83 to 2001, then honestly extreme value increases and losses and very high volatility up to today. So point number one to remember is your real estate market has ever-increasing volatility and thus ever-increasing risk to you. The increased volatility is making it nearly impossible to tell when a true downturn begins or when it's just an oscillation in the value trend. With all the value increases we studied, let's try not to forget that ever-increasing value volatility can obviously create losses as well as the gains you've witnessed. If you bought your home in 2007, your home's value was substantially lower than what you just paid for it for 6 years until 2013. And you didn't have this chart in front of you during that time to see the future. You did, however, have a perpetually declining home value, horrific daily news reports, your full mortgage payment, and continuous upkeep and repairs to pay for. Obviously, if you tried to sell during these years, you were doomed. Any plans you had were frozen in place, or you had to get ahead of the proverbial falling knife by slashing your home's asking price by perhaps twice the rate of the current market price decline, and do so quickly. Any hesitation cost you increasing losses each day. These millions of homes that either could not sell or sold for an average value loss of 30% through 2009 were the exact same homes in the exact same locations with the same renovations that sold for record prices in 2007. So point number two to remember, timing your home sale or purchase makes or loses you more money than anything else you can do. Timing the real estate market is more important than location, renovation, or hesitation. So in part one of this series of timing the real estate market, we've noted how volatility in values of properties has both increased your leverage for high profits, but has also increased your leverage or your probability for high losses. In part two of this series, we're going to talk about how real estate values act before, during, and after recessions. I'm Creed with Smart Sell AI. Thanks for your time.